Welcome to Herb W. Morgan's Slaying Bulls and Bears, a podcast about economics, markets, investing, politics, and profit. Every Monday, in less than 20 minutes, Wall Street portfolio manager Herb W. Morgan distills the complex and complicated into the simple and sensical. Here's Herb now.
Good morning, everybody. Tuesday, May 28th, 2024. I'm Herb Morgan, Senior Managing Director and Chief Investment Officer at Cantor Fitzgerald Managed ETF Portfolios. Don't forget, if there's commentary intro week, we'll either put it out as a short on the YouTube channel or on the Twitter or the X at ETF_strategist or on LinkedIn, Herb Morgan. So you should be able to find it in all of those places. The presentation you are seeing and or hearing has been prepared by me with Cantor Fitzgerald Investment Advisors for use with both investors and their financial advisors, but each are expected to make their own investment decisions. Nothing contained in the presentation should be treated as investment advice. No recommendations for the purchase or sale of any securities. Everything is purely for informational purposes, and its accuracy, adequacy, or completeness cannot be guaranteed. Well, for the first time in a few weeks, we had a down week. The preponderance of the equity indices, I should say, were down. As you can see, bring out my trusty laser pointer here. Down across the board. China took the biggest hit, down about 2%. The EFI down about 84 basis points. Mid, small cap stocks both down. But the S&P 500 managed to edge out a small gain. What's going on? Well, big cap U.S. tech. Do I sound like a broken record yet? It's been years. We don't see this trend changing anytime soon. NASDAQ, therefore, positive as well, hitting a new all-time high last week. Thank you, big cap U.S. tech. Fixed income on this sort of gains and some data, which I'll show you in a minute, that showed some reacceleration of demand, therefore reacceleration of some of the inflationary pressures. Sent the bond market modestly lower last week. The aggregate bond index down about 28 basis points. Let's get into that data specifically now. Start with existing home sales. April, existing home sales fell almost 2% annualized, but the estimate was for an increase of 0.8% annualized. So that's back-to-back declines. The March decline was much, much larger. And what we're seeing for the first time, according to Lawrence Yun, the economist at the National Association of Realtors, is that inventory is beginning to rise. That's good, ultimately, for prices, for those looking to buy. It's good for inflationary pressures, but it's rising from an incredibly low level. Still not up to the level before the pandemic in 2020, and the supply of homes available for sale is up to a whopping, and I'm tongue firmly implanted in cheek, to a whopping 3.5 months. That's 16% higher year over year. If you've gone on a Zillow and checked the value of your home, for example, you've seen it go up. Most likely, you've seen it go up and up and up over the last year. And now that is also pulling some sellers out of the market going, well, maybe it is time we did downsize or do different things. So a little bit more supply, still not enough to get us to an equilibrium in the market. So the preponderance of the pressure on residential real estate is still higher. Moving on to new home sales. April new home sales down almost 5% annualized. That's more than double the expected annualized decline of 2.2%. So 7% mortgages have that impact. And believe it or not, despite how great the labor market is, I'm going to show you slides in a minute that consumers may be starting to get a little bit stretched. Initial claims for unemployment remained very low. They fell to 215,000. The estimate was for 220. I've said all along, I'm going to go, here's my little red dot at 300,000. Anything below 300,000 is quite healthy. At 200,000, it is robust. Moving on, we got the flash readings from S&P Global for the U.S., for manufacturing, for services, and then a composite reading. We'll get the final readings here this week or next. I can't remember exactly, but it's always early in the month of June. S&P Global Manufacturing rose to 50.9. Remember, there was concern because we were right at 50 last month that we were going into contraction. It was concern sprinkled with a little bit of relief. What would the relief be? Well, if we went into contraction on manufacturing, that would show a slowing economy. That would bring down inflationary pressures, and that would give the Fed the room to do what they want to do, which is to cut interest rates. But that's not what manufacturing did. It didn't decelerate, it accelerated. And it's only about 15% of the US economy, and services is a much bigger part of the US economy. It's about 85%. The same reading, but applied to the service side of the US economy, rose to 54.8. And you can see if you take the line here and you go all the way across, we haven't had anything like a 54.8 since March of 2022. Take a look at the composite, you can see the same thing. The composite reading, you can see came in at 54.4. The last time we were that high, also back in 2022. So I've been saying for some time that there's a significant risk of re-acceleration inflation. Not only may the Fed not get to target per se, we'll know more this week, we have a big report this week, but there's a risk of re-accelerating the inflation while some segments of the economy are still slowing or still growing. It's all over the board right now. But the point is we can't discount that. And if you pay attention, you don't have to, I'll do it for you. I pay attention to all of the Fed speakers. Every week there are a number of Fed speakers. They speak at universities, at luncheons, at business events around the world. And they very clearly, I think, indicate what they're thinking. And the preponderance of the Fed speakers in the last 2 or 3 weeks has been, we need to wait before we cut interest rates. Therefore, the odds of a September cut remain, I think, off the table, although the market says there's an 80% chance. And then the more likely would be November. And I think even that is going to get pushed out unless I'm wrong and we do see, downward pressure on inflation. Consumers reported with the University of Michigan, if I could get these slides to advance for us here, let me get that going. And here we go. University of Michigan consumer sentiment fell from 77.2 to 69.1. It was better than expected. Let me get that laser pointer back out for you. Better than expected, but still pretty low. Why? People are concerned about inflation. It's the cost of milk and eggs and gasoline and energy and water and everything else we have to consume, not to mention the price of homes or the owner's equivalent rent or rent of homes and living expenses. Durable goods gained for the second consecutive month. They were expected to go down. So that's it's 3 consecutive months of increases for durable goods. Capital goods orders taking out non-defense aircraft up 0.3%. So you see this re-acceleration in manufacturing. You see this re-acceleration in services. We really have no unemployment. Big cap tech earnings are fantastic. The stock market, as measured by the NASDAQ, new all-time high last week. Very recent all-time highs in the S&P and the Dow. Interest rates aren't particularly high. They're not as low as a lot of us would like them, but they're not particularly high, at least by historic standards. But something is happening with consumers, with labor, with citizens, with sort of the non-investor class, which is the majority of us, the majority of Americans. And this is what I'm talking about. This is serious delinquencies, which are defined by you're 90% behind in your payments for credit cards. So all ages, all across America, 90 days delinquent. We're getting close to 7%. Well, even going into that recession in 2000, we weren't that high. So we're higher than we were before the pandemic. The low delinquency in this period shows, the consumer's doing well, right? They're doing well. They're making their payments on their credit cards. When they stop making the payments, they're not doing well. Why is that? Probably the inflation situation, right? But the last time we were this high, and by the way, this recession was a supply side recession, not demand. It almost doesn't count. in my book, right? We shut off supply in the economy. But if you go back to this level, right, you can see there is your 2007, 2008 recession. Go back even further, and you see you're at your 2001 recession. So what this tells me is even though things are good, and even though manufacturing numbers are good, and the service sector is good, and the employment level is good, there's something happening beneath the surface that is not good, which tells me we're in the late stages of the economic expansion, which would mean, of course, the Fed could cut rates, but the Fed can't cut rates if inflation doesn't come down. That's that reacceleration of inflation. And if you have acceleration going up while growth is muted or potentially contracting, we call that stagflation. That's truly the worst of all worlds. And that's a challenge for our asset price values. It would be a challenge for equity values. It would be a challenge for real estate values, really for just about everything. In addition to the credit card delinquencies, we've got auto loan delinquencies. Auto loan delinquencies also rising up to almost 3%. Last two times we were here, well, we're well above where we were in the 2001 recession, right? So the Fed is seeing all of this. The Fed really wants to cut rates. You cut rates, you help the people with credit card balances, you help the people with auto loans, you help the people with adjustable rate mortgages. It helps a lot of folks, right? But your mandate is fostering price stability. Okay, moving on, the shortened week. Yesterday, as we all know, was an incredibly important day to everybody. Memorial Day, we'll remember those who gave their lives for our freedoms and our country. And then we move on to today, Tuesday. FHFA House Price Index up 0.5% is expectations. Case-Shiller home prices up 0.3 expectations. Consumer confidence 96. Only thing on Wednesday is the Fed's beige book. That's the board book, essentially. That's a compilation of all the Fed districts' reports that each of the voting members gets. They can read and make their decision on interest rates. We don't expect anything coming up anytime soon in terms of a cut, as I've told you. Jobless claims first quarter GDP looks like it may have accelerated from the first report of 1.6 down to 1.3. Pending home sales expected to decline a little bit. Personal income spending on Friday. But by far, the thing that matters is the PCE, Personal Consumption Expenditure Price Index for April. Anything 0.3 or above, I don't think is particularly good. If it comes in below 0.3, then that will pull forward the expectations of rate cuts, and the market would rally. I think it would rally if it got that. And then Chicago PMI. Thanks, everybody. I'll be back to you again next week. Remember, this is available on my YouTube channel, Slaying Bulls and Bears, or Herb Morgan, but it's also available audio version only in all your favorite podcast formats. Thanks, and I'll be back to you again next week.
Thank you for listening to Slaying Bulls and Bears. If you'd like to download the slides for this week's podcast, go to www.efficient-portfolios.com and join our mailing list. Don't forget to subscribe to our YouTube channel, rate us online, and share with a friend if you found this helpful. See you next week.